Florida's condo market isn't just spiraling, it's crashing in ways almost nobody predicted. In some towers, units that sold for $500,000 just 2 years ago now barely find buyers at $250,000 or less. Owners are waking up to surprise $30,000 to $80,000 special assessments. Insurance bills that used to be manageable are now crippling. And in certain cities, sales volume has flatlined. In one building, a dozen units remain unsold even after repeated price cuts. In another, lenders simply refuse to finance, and only all-cash buyers remain. The question is, how did we get here so fast? And is a 50% price drop a fantasy or already happening behind closed doors? To understand that, we have to first see how Florida's condo bubble was built and then unspooled. When the pandemic struck, Florida was ready to be America's escape hatch. Remote work, low taxes, and beachfront daydreams drew waves of buyers. Between 2020 and 2022, Florida's condo prices didn't just climb, they rocketed upward. Some metro areas saw 40% to 70% gains in just 2 years. In the Tri-County South Florida region, Miami-Dade, Broward, Palm Beach, average monthly condo sales peaked around 134 units in Miami, 964 in Broward, and 839 in Palm Beach at the height of the boom. But by 2025, those numbers had collapsed. Miami alone fell to about 917 units sold monthly. Inventory, in contrast, swelled. Condos under $500,000 now face 11 to 12 months worth of supply, a buyer's market for the first time in years. It wasn't just South Florida. Across the state, condo and townhome inventories surged. As of 2025, Florida had nearly 80,000 such units listed for sale, up about 35% year over year. That buildup pushed months of supply well past 10 months in many markets, far more than the 5 to 6 months typical in healthier markets. Prices followed. In the months after 2022, median condo prices across Florida started sliding down about 8% from peak in some markets, outpacing declines in single-family homes. By early 2025, in 92% of Florida metro areas tracked, condo prices were falling. Why did the boom go so far and leave such a trap behind? There were several powerful forces fueling the rise and accelerating the fall. 1. Hyper-accelerated migration and speculative bets. The spike in in-migration was unlike anything the state had ever seen. Between March 2020 and June 2022, Florida's home prices jumped 51%, higher than the national average of 41% in that same period. Many buyers didn't do deep due diligence. They were chasing momentum. Some purchased purely on virtual tours or renderings. Developers responded by delivering towers, often without fully ensuring the long-term structural health of those buildings. Too easy credit, low rates, high leverage. In the boom years, financing was generous. Many buyers locked in low interest rates or floated speculative deals, assuming values would only go up. That's a bet that unravels fast when rates rise. 3. Deferred maintenance and weak reserve funding. Many older condo towers had neglected maintenance or underfunded their reserve accounts. As projects aged, structural issues like water intrusion, spalling concrete, corrosion, and outdated waterproofing loomed. The real estate press warned that post-Surfside, Florida's older condo stock would need an avalanche of capital to catch up. Recall the Champlain Tower's south collapse in Surfside 2021, which killed 98 people. That tragedy opened scrutiny on structural safety, accelerated inspection mandates, and spooked buyers. It also raised awareness that some aged oceanfront towers were in worse shape than many had imagined. 4. Regulatory and inspection changes after Surfside. In the wake of the collapse, Florida passed tougher laws requiring structural inspections, maintenance of reserve funds, and transparency from condo associations. Suddenly, many buildings discovered major repair backlogs. That accelerated special assessments and forced boards to confront decades of underinvestment. 5. Overbuilding and market timing mismatches. Developers, sensing endless demand, overextended. Entire towers were launched without waiting for absorption. In some areas, there was more supply than demand, especially in secondary or fringe markets. Some units sold well above what local incomes could support. Once interest rates rose and demand cooled, those speculative units became liabilities. 6. The fragility of peak pricing. Because so much of the price gains were speculative and forward-looking, i.e., based on expected demand, not intrinsic value. When demand cooled, those price levels proved unsustainable. The peak valuations had little margin for error. By mid-2023, the cracks were already showing. Markets started to pause, then retreat. But most observers still expected a 10 to 15% correction, not a collapse. That's what made what comes next so much more dramatic. We'll now move into how hidden carrying costs blew up the ownership math and laid the groundwork for what looks increasingly like systemic implosion. As condo prices climbed, many buyers ignored, or were unaware of, the hidden carrying costs quietly eating away at returns. But from 2023 onward, those costs exploded. Now, for many, ownership is not just risky, it's a money sink. Let's break down the 3 cost drivers that are doing the most damage: insurance, assessments/repairs, and HOA/association dues. And then we'll see how they combine to crush dozens of condo markets. 1. Insurance premiums, from manageable to unsustainable. Insurance is the silent tax that's become impossible to ignore. In Florida's condo market, association master policies and individual unit policies have surged dramatically. According to one legal analysis, average commercial or association-level insurance costs in many condo buildings have more than doubled since 2022, rising approximately 103% in many cases. Individually, condo owners' insurance premiums that were once in the ballpark of $1, $500, $3, $500 annually are now routinely pushing $8,000 to $15,000 for waterfront or high-risk buildings. In Florida's metros, the rate of increase in HOA dues, which often include insurance cost burdens, is especially steep. In Tampa, HOA dues jumped 17.2% year over year as of mid-2024. Orlando's rose 16.7%, Fort Lauderdale 16.2%. Many condo associations now pay insurance rates for wind, flood, structural risk, general liability, and defect coverage that earlier would have been considered extras. With fewer insurers willing to cover Florida risks, the pricing pressure is acute. What's worse is how this premium escalation is treated by Florida law. In many cases, insurance costs are excluded from statutory caps on how much assessments can increase year over year. In other words, even if regular fees are capped, insurance hikes are carved out. As a result, insurance increases become uncontrollable burdens. And once one building sees rates jump, insurers re-rate entire clusters of properties. That ripple effect can destroy the financial assumptions of every owner in a tower. But inflated insurance alone doesn't push values down 50%. That's just the baseline. The next cost category is where many owners get blindsided. 2. Special assessments and structural repairs, the surprise hit. Special assessments and deferred maintenance are the second dagger. These are the occasional one-time charges that suddenly show up on your doorstep, often tens of thousands of dollars per unit. Florida law requires condo buildings to perform structural inspections, milestone inspections, and maintain reserves for repairs in response to the Surfside 2021 collapse. Boards must plan for things like facade replacement, plumbing, relining, deck waterproofing, corrosion control, elevator repair, etc. Many older buildings deferred those repairs during the boom years. Now the backlog is immense. Some associations are proposing $20 million, $30 million, or more in capital repair programs. That gets passed to unit owners as special assessments. In one Florida condo community, residents were told their one-time assessment would be $22,000 in order to comply with structural reserve requirements, leaving many unable to pay and forcing forced sales. These assessments are not trivial. They can run $10,000 to $50,000 or more per unit, depending on building size, damage, or repair needs. And since many units are over 30 years old, large-scale systems, roofs, balconies, rebar, electrical upgrades, are often needed. Special assessments are legally allowed beyond normal budget limits, even beyond the 115% cap in some cases, because legally, insurance and reserve funding for structural repairs are excluded from that cap. These sudden, unpredictable bills become shock events. Owners who bought expecting modest HOA rises get slapped with enormous repair bills they never planned for. Many either liquidate or default. Those defaults feed into lower values for the rest of the building. 3 steep HOA/association dues the daily burden. Then there's the routine component, what you pay every month just to belong to the condominium. HOA dues or condo fees in Florida are climbing aggressively. Some have increased well beyond inflation. On aggregate, according to Redfin, HOA dues in Florida metro areas rose more than 15% year over year in markets like Tampa, Orlando, and Fort Lauderdale, far higher than the 6% national median. In extreme examples, fees have more than tripled over time. One condo complex's monthly dues soared to $3, $371 per month in one case, forcing residents to face losing their homes if they can't keep up. Even in buildings without major amenities, dues are now being priced as if they were luxury properties because boards must fund reserve accounts, insurance premiums, structural inspections, and maintenance. Rising fees reduce the pool of prospective buyers. A buyer who might have qualified for a mortgage is now disqualified due to excessive debt service ratios once HOA and insurance are factored in. 4. The perfect storm when all 3 collide. Individually, these cost drivers are painful. Together, they form a perfect storm, making homeownership in many condo towers negative cash flow. Imagine this in a real example. You buy a 2-bedroom condo for $300,000 at 6.5% mortgage interest. Insurance premium rises from $4,000 to $10,000 per year. HOA dues escalate from $400 to $750 per month. A special assessment hits, $25,000, financed over 5 years, $400, $420 per month extra. Add in taxes, utilities, maintenance. Your monthly owner costs, mortgage plus insurance plus HOA plus assessment repayment, may exceed $3,000 to $3,500. In many markets, comparable rentals cost $1, $800, $2, $200. So you are bleeding money every month just to own. Once sellers realize they lose money carrying the unit every month, they flood the market. Buyers retreat. Values fall further. In some Florida building boards, they're spitballing scenarios where 30 to 50% of units are held by owners who can't make payments, face foreclosure, or stick units on the market at steep discounts. These are not hypothetical. Condo associations and attorneys are privately warning of such outcomes. Later in this video, we'll dive into cities and buildings where that death spiral is already well underway. But first, we need to see how the math of decline is quietly accelerating. Claims of a 50% price drop in Florida's condo market sound like dramatic clickbait. But when you peel back the surface, you start finding cracks in certain markets. Cracks that hint the half-off scenario may already be playing out in hidden corners. And as those cracks widen, they threaten to spread. To see how far this might go, let's examine the data, the anecdotes, and the markets where this kind of collapse is less hypothetical and more quietly unfolding. 1 deep declines in distressed and older building. Across multiple cities, condos built in the 1980s or earlier are taking the hardest hits. Parco Labs found that in Tampa, 60% of condo listings have already had price cuts, and many are shaving off double-digit percentages just to draw interest. Meanwhile, in markets such as Jacksonville and Orlando, supplies are rising by 38 to 59% year versus year, while buyer demand is falling by 12 to 16%. In Deltona, one of the hardest hit metros in the Redfin dataset, the median condo sale price is down 32.2% year over year, a collapse that edges toward the half-off headline. In nearby Crestview, another Florida metro, condos are down roughly 32% as well. Now, that's not the same as 50% yet, but it's getting dangerously close in some cases, and these deep declines tend not to be uniform across all buildings. They show up strongest where buildings failed inspections, lacked reserves, or were over-leveraged from the start. 2. The blacklist and financing freeze effect. One of the most potent accelerators of extreme declines is when lenders refuse to finance units in buildings flagged for structural deficiencies or insurance problems. These condos often get placed on Fannie Mae or FHA blacklists, making mortgages nearly impossible. Only cash buyers remain. According to recent local real estate reporting, 1. 400+ Florida condominium buildings are now blacklisted. That's an enormous chunk of the inventory. In those buildings, sellers cannot lean on typical buyer demand. Many must slash prices heavily just to attract the few remaining all-cash buyers. When a building loses access to conventional financing, its market value can drop by 10 to 30% instantly because the pool of potential buyers shrinks dramatically. In the worst cases, values might need to fall 50% or more just to broaden the buyer pool again. 3 overbuilding plus inventory glut as pressure multipliers. Even when a building is theoretically sound, it can be dragged down by the overall market weight. Across Florida, condo inventory is exploding. The state has close to 80,000 condos and townhomes for sale, up approximately 35% from a year ago. Inventories now represent over 10 months, supply in many areas, far above the 5 to 6 month norm in healthier market. In Miami, there are 251% more sellers than buyers in some condo segments, giving buyers rare leverage. With so many sellers competing, discounts multiply. Sellers drop $20,000, then $50,000, then $100,000. As price reductions ripple through, they compress values across the board. So even buildings that were safe begin to decline because comparables, other units, are falling. In markets like Tampa and Cape Coral, this glut is acute. Some towers with over 2,000 units on the market struggle to attract even a single bidder at asking price. And when buildings lag, maintenance and repair deferrals pile up, further eroding value. 4 anecdotes and extremes, stories that hint at 50% reality. Numbers alone can't convey the fear in owners' eyes. Consider a few examples. In a mid-rise building in a secondary Florida city, several units are now listed at half of what they sold for in 2021, but with caveats, must be cashed or reparable only. A 2025 WSJ article reports entire buildings being dumped on the market because owners can't handle 6-figure repair assessments. Local news reveals that in small condo complexes, HOA fees have tripled, and special assessments of $50,000 plus per unit are now common. One Florida condo board president in Boynton Beach faced a $7 million repair project, approx $15,000 per unit, and then accidentally got his building blacklisted due to a clerical error. Sales froze. These stories illustrate how a building does not need to collapse entirely to suffer a de facto halving. Structural distress, unaffordable fees, buyer avoidance, they all combine to push value sharply downward. 5. What stops 50% drops and why those barriers are breaking? If 50% falls are possible, why haven't they happened everywhere yet? A few factors still act as buffers. New luxury towers built in 2022 to 2025 in pristine condition are still holding value better because buyers trust new construction more. Desirable locations, ultra-prime coastal zones, major metros retain more demand, helping those condos decline more slowly. Tax incentives, state programs, and subsidies may buffer some buyers temporarily from full pain. Gradual regulatory relief, e.g., allowing associations to borrow, pausing reserve requirements, introduced in 2025, can ease some short-term pressure. Yet all those buffers are eroding. The credit freeze in distressed buildings sets off cascading effects. New Tower A might still sell at 80% of peak, but Tower B, older, tougher location, might already be at 50%. Over time, that damage spreads. So when someone claims minus 50% drop, they're not just chasing clicks. In certain buildings, with blacklisting, massive repair bills, and no buyers, 50% or worse is already happening. And unless something intervenes, those micro crashes could become macro trends. To see how this is playing out on the ground, we next dive into the hardest hit cities, the places where these half-off collapses might already be unstoppable. Not all Florida condo markets are collapsing at the same pace, but in several mid-tier and secondary markets, the damage is already deep and accelerating. Below are some of the cities and submarkets quietly hemorrhaging value, along with the red flags you won't see in glossy headlines. Cape Coral, once a poster child for Florida's boom, now leads many real estate analysts' collapse watch lists. The Wall Street Journal dubbed it the worst housing market in America, citing overbuilding, plunging demand, and insurance burdens, dragging valuations downward. In recent months, up to 55% of listings in Cape Coral have received price cuts, more than half the market adjusting downward. The local MLS reports that property prices declined 12 out of 13 months, with 52% of homes undergoing reductions in list price. Alongside price falls, inventory is ballooning. Cape Coral has thousands of homes for sale. In some estimations, over 12,000 listings in Lee County alone, triple what normal absorption would justify. One study flagged that 8% of homeowners in the Gulf Coast markets now owe more than their homes are worth, i.e. underwater. Even local realtor groups have bristled against the negative framing. The Royal Palm Coast Realtor Association publicly disputed how the WSJ characterized the market, not to dispute trouble, but to argue the picture is more complex than a collapse narrative. But even their own pushback underscores how severe the pressure really is. Hurricanes, rising sea levels, flood maps, and insurance costs make this particular crash more volatile. They came in droves via Zoom, the WSJ notes, but many now live in regret as equity erodes. In larger metro areas that many thought would remain resilient, the condo downturn is infiltrating even blue-chip markets. In Tampa, we already see median condo prices sliding from 2022 peaks of around $310,000 to closer to $230,000, a 25% drop in core sectors. This matches what we referenced earlier. Inventory in the Tampa condo market has spiked by 85% year over year, with about 4,000 active listings, the highest since the Great Recession. Again, from earlier script. In Jacksonville, the median fell from about $230,000 mid-2022 to $180,000, a 22% decline, while over 800 condos sit unsold. Also from the earlier script. What you might not realize, many of these listings are concentrated in older towers, which lenders now rate as too risky to finance. That means only all-cash buyers remain, shrinking the pool drastically. Some of the most serious damage is happening in buildings that were once considered safe bets. Older coastal towers or mid-rise condos that superficially look solid until you peer beneath the surface. These towers often face deferred maintenance, weakening infrastructure, and corrosion from salt air. The new Florida law, passed after the Surfside collapse, forces mandatory inspections and repair reserve requirements. Suddenly, many of these buildings have million-dollar repair backlogs. In South Florida, a University of Miami study discovered that nearly 36 condo and hotel buildings are sinking or settling by 0.8 to 3.1 inches, even among units less than 10 years old, a structural stress no owner wants to see. In Miami itself, regulators are grappling with buildings flagged for instability, dozens of towers now under scrutiny, which makes lenders even more cautious about underwriting units there. What this means is the safe coastal condo narrative is fraying. Just because a tower is newer or seaside doesn't mean it's immune. The tension between nature, structural wear, and regulatory scrutiny is exposing risk in places once considered lowest risk. You don't always hear stories from smaller cities, but that's where some of the steepest declines are quietly taking place. These are places with less name recognition, fewer navigable headlines, but very real bloodletting beneath the surface. Cities like Lakeland, Northport, St. Petersburg, Deltona are flagged as high risk of price decline in Florida housing forecasts. Florida condo prices overall have been continuously sinking since July 2024 by 6.1% year over year as of mid-2025. That's nearly double the decline seen in single-family home markets. In the Newsweek report, smaller metros saw condo indexes fall more steeply than houses, showing how vulnerable condo sectors are across the board. Towns with developing infrastructure and speculative growth, once viewed as hidden gems, now resemble ghost prospects. That's where some of the rumored 50% downward moves may first solidify. These secondary markets are especially vulnerable because they lacked the financial cushion, prestige, or demand resilience of places like Miami or Orlando. Now they're being exposed. Put these threads together, and a pattern emerges. Core coastal markets are showing structural stress but haven't collapsed across all properties. Instead, problems are concentrated in weaker or older towers. 2 mid-tier and secondary markets, especially inland or less glamorous cities, are already showing sharper declines and may be far ahead in the crash timeline. 3. Inventory floods plus financing withdrawal is a common theme everywhere. Even markets that haven't dropped 50% yet are vulnerable to cascading declines if buyer confidence breaks. 4. Regulations and inspections are now amplifying the drop. Buildings failing mandatory inspections are being blacklisted, cutting off lending and forcing deeper discounts. 5. Human fear and momentum matters. When one building starts receiving structural red flags or extreme assessments, nearby towers, values fall by default. If even a few more cities cross critical thresholds, too much debt, too little demand, uninsurable towers, the hidden 50% drops may start bleeding into headline markets. And that's exactly what we'll examine next. Who's next in the crosshairs, and how far the dominoes may fall.